What is the bond market thinking? It's a very well bid bond market today in the U.S.
Yeah, and that's all about trade. It feels like since September, we've seen a bit of a sell-off as kind of the mood music has turned more positive on trade. But, you know, the idea that maybe this deal would be delayed for a year and we might get a tariff increase in 2 weeks really has investors rattled. And that's why you're seeing Treasuries lead the way in terms of this global bond rally right now.
In terms of what could happen with the Fed, could the Fed be drawn back in to cutting rates if we don't see any rollback? At the moment, the data, and we saw the ISM manufacturing data earlier on this week, seems to indicate that the trade war is clearly having an effect in key sectors of the economy. If we kind of work to Trump's new timeline, will the Fed have to maybe bring up sort of further rate cuts in 2020?
That's a really good question. So I was looking at this just before I went on, and we have a Fed meeting next week, and there's still nothing priced for that. But if you zoom out and look at 2020, there's about a cut and a half priced in right now, about 35 basis points. But we don't see that first cut priced in until the September 2020 meeting. But obviously the question on everyone's mind is, you know, if we do get that tariff increase, if we do get delayed, dragged out uncertainty, maybe the bond market will start pulling that cut that's priced in further, you know, further or closer from 2020.
Now, we're also seeing quite the moves in Europe as well. Italy, for example, I hadn't been looking at Italy, but, you know, a 60 basis point move there. Obviously, the German move too. How much are the bond markets sort of speaking to each other and how much are they acting solo?
It's definitely a synchronized global move. It makes sense that the Treasury yield is falling the most here since it has the most room to fall. But, I mean, to your point, you're seeing Italy, Germany move. So these big, important developed market bond markets are definitely acting in sync here.
Just looking at what kind of effect the last few days have had, risk parity funds kind of usually balance what's happening in the stock market with what happens in the bond market. The bond markets and the stock markets, not today, but for the previous two sessions, sold off reasonably aggressively together. Is that becoming a more common phenomenon? And how are risk parity funds trying to deal with it?
Well, it's interesting. If you look at the correlation between the stock market and the bond market, that correlation has been weakening. And it makes sense that that would be weakening if the driver is trade. You know, any bad news on trade, any further delay, that's clearly negative for equities, and it's clearly good for bonds as a safe haven bid. So you're kind of seeing a dynamic shift underway, and it'll be interesting to see how those risk parity funds deal with that.